Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Kevin O'Nolan from Fidelity. Hi Kevin.
Hi.
So in December, the Federal Reserve raised rates for the first time in 7 years, and at the time everyone was very enthusiastic and they predicted that 2016 would see another 4 rate rises. This hasn't happened. Why is everyone so much more gloomy about the prospect now?
Well, I think we came into 2016 and immediately there was quite considerable financial market volatility and really centered on China. So the currency weakened for the second time in 6 months, and that really rattled markets. At the same time, growth data was coming in a little bit weaker. I think this was really what was concerning the Fed. It was whether or not that weakness in EM was going to feed over into some of the measures that they look at, so US inflation and US growth. And it just meant that they wanted to pause for a little bit. I think it was quite sensible. And I think what we've seen in the last few weeks is better data and better markets.
So fast forwarding 6 months, we're now in May, and a lot of people are saying that June, July, we are going to have another rate rise. That seems to be the consensus view. Would you agree with that? And what's happened, I think you alluded to it then, to make people think another rate rise is coming?
Yeah, I think it's a high probability at this stage. I think that what unemployment data is continued to be pretty much at target for the Fed, and what we've seen is that inflation data has started to pick up for the first time really in a couple of years. At the same time, those two things that I pointed out in terms of what was weak in Q1, so growth and also financial markets, have improved, and so the Fed have clearly looked at the way that markets are pricing and said that we need to bring back in this prospect of a summer rate hike. So the April Fed minutes showed that June was a real possibility, and in the speeches by Fed governors, Fed board members in the last couple of weeks, they've continued to confirm that. Now over the next 10 days we've got some key data points in terms of core inflation. We've also got May business confidence and the May jobs report. And I think if those 3 reports continue on their recent trend, I think Chair Janet Yellen is likely to hint at her speech on the 6th of June that they're likely to raise rates.
Okay, so let's say we do have that positive trajectory, all the planets align, and the Fed raises rates either in June or July. What does that mean for investors?
The most obvious impact is in fixed income, so I think it means higher bond yields. But sort of taking that a step further, I think one of the key beneficiaries over the last few years has been a stronger dollar. Because the Fed is the only major central bank tightening policy, the dollar has been quite strong, and I would expect that trend to continue. Similarly, it's a negative for emerging markets, and it puts downward pressure on emerging market equities. For the broader equity market, the jury's sort of still out, I think. What we've seen in previous tightening periods is that equities can continue to do quite well, but most of the returns come from earnings rather than from ratings. So really it's a question of whether or not earnings can bounce back from here, and if that is the case, then I think equities can do quite well.
Kevin, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.